Okay, I believe we are live. So thank you very much, everybody, for tuning in to another live stream. This is number 25, I believe. And today's subject is, we don't talk about it a lot. In the VTS community, my videos, articles, we typically talk about the how to invest, how to get the best rate of return using volatility, options, tactical investing, reducing drawdowns, how to achieve the best rate of return. But sometimes it is important to circle back and look at the big picture and ask some macro questions, goal setting, what is actually required. And certainly in this social media age, I think it's important now more than ever, because with each passing year, with the influence of online gurus, as we would call them, it's becoming difficult to filter through the noise. Everybody out there seems to be promising 50% a year, 100% a year. Join my community, I'll double your money in a year. All of this nonsense is really getting people to the point where they're not even really sure what a good rate of return is anymore. So today's live stream, I wanted to circle back and sort of get everybody down to more realistic expectations of what can actually be achieved. Because quite honestly, and I feel very comfortable saying this, very confident, all of those people that you see online, on Twitter, in the chat forums, that are promising those staggering rates of return, honestly, every single one of them will fall well short of that. And probably the vast majority of them will just outright collapse, because when you're chasing performance that is completely unrealistic and unachievable, what ends up happening is you're essentially just taking on massive risk, and you're hoping that it works in the short term so you can get a bunch of followers. But I feel confident in saying that pretty much every single one of them, and I would like to say everyone, but you got to leave a little bit of room for someone to just get lucky, but 99.99% of them will just fail spectacularly. So we are going to talk about realistic rates of return and how everybody out there, regardless of your income, regardless of where you stand as far as your life goals, everybody can retire a millionaire. So that's essentially what we're going to be talking about today. Now, I do want to mention that my live streams recently have been going very long. So today we're just going to do one topic, and then we're going to go right to the Q&A, and I'm just going to see how the timing works out. What I would like to do is get the live streams to 1 hour only, and then if necessary, we could start doing two a week. That would be better than doing one per week for 2 hours. So I know I say this a lot, but I really am going to try to cut this at 1 hour. So let's get right into the intro, and then we'll get started. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osajov. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, apologies everybody. I don't know what's going on. So what I'm trying to do here, apparently I'm live streaming on the wrong channel again, but what I'm trying to do here is use this new software called Restream that allows me to stream to multiple different places. And let me just show this, just so maybe somebody out there, if you're tech savvy, maybe you can just figure this out, because I really don't understand what's happening. So essentially, I have two YouTube channels. I have one that's just clips, and then I have one that is the main channel that I always live stream from. And I am currently logged into the main channel, so everything's fine. I prepared a live stream, and this is the one right here that is supposed to be going live. I did all the tags, I did the screenshot, everything is set up to go. And before I started using Restream, that's what would happen. For whatever reason now, as soon as I click Upload Live, it creates this new one. And then, of course, everybody kind of doesn't know which one to show up on, and it's on the Clips channel, and it's on Facebook. So I really don't know what's going on. But for whatever reason, see, this one is still just sitting here. Nothing's happening on this one. This is the one that I clicked go live on, but it actually didn't go live. This is just going to say that they're waiting for me. There's 19 people waiting on this live stream. So I don't know what's going on. So what I'm going to do, because this is just extremely annoying, what I'm going to do next time is I'm just going to not use the Restream for 1 week and see what's going on. I have to kind of reset what's going on here. So hopefully more people will pour in and we'll get the normal amount of people. This happened last week as well. It's very frustrating that you do a live stream and people are looking to get on it and they save the time or whatever, and then technical difficulties happens. It's always something. So this is what happens when you're not very tech savvy, like I am not. But like I mentioned in the intro, that very few people were around watching, and there's very few people watching the live stream right now. I think I've just confused everybody, and they've all just tuned out and left. But what I was talking about in the intro is realistic expectations. So I'm going to do a presentation here about sort of a number that I've thrown out there in many of my live streams, a lot of the articles and videos. I always mention this number of 12% per year. And of course, it's not every year. It's not like clockwork. Obviously, investing doesn't work that way. But it is a long-term average 12% a year number. And so we are just going to go ahead and discuss what I have prepared here. And hopefully enough people circle back and actually find this live stream. So apologies for that, but let's get started. So essentially what we're talking about, like I said, it's more big picture stuff today, where we are trying to get a handle on a realistic expectation to be able to retire a millionaire. And a millionaire, it's not necessarily some number that people have to hit. It's just a very general, broad way to speak about a successful retirement. So don't think the million, you have to hit 1 million and more than that. You don't need less than that. If you don't hit your goals, then you've somehow failed. It's not that. It's just that I'm speaking to a general audience. So that's kind of the benchmark number that we're going for. And I've always said that it's actually simple. That's why I said simple, but not easy. It is very simple to retire a millionaire. It is just 3 steps. Number 1, you do want to build up a good income for yourself that covers your life expenses and covers your family if you've got one, and whatever hobbies you're going to take part in. This is obviously important. Everything starts from income. So it's not something that we get into a lot within my community, but it is a very big part of the long-term process. Build yourself a good income. Now, obviously, beyond the scope of today's live stream, excuse me, but a few things that you would definitely want if that's what you're trying to do is build your income up. Obviously, you'd want to be choosing something that you are somewhat interested in and that you are somewhat good at, or at least are trying to pursue being better at it, because that's going to help with the motivation and determination to keep going. The average income in the United States, the median individual personal income, is about $36,000. I believe I pulled that up somewhere here. Real median personal income in the United States, $35,800. So this is essentially the average income. Now, if you're trying to be better than average, you are going to have to work harder. There's no way of getting around that. So working harder and getting motivated and disciplined is much easier if you're interested in the subject and you can actually stay motivated. So that would obviously be a very good step one to get yourself a nice income. Step two, also extremely important. We talk about budgeting and little tips here and there a little bit in the VTS community, but again, we are mostly talking about investing. But obviously, you are going to want to live below your means and save as much money as you can. Now, again, this is a problem with the social media age that we are all encountering in the last decade or decade and a half, and it's getting worse every year, is that we are living in an age of essentially ultra materialism. That marketing is just directed at us and making us all feel inadequate if we are not keeping up with everybody else and showing these fancy lifestyles. And it's becoming more and more difficult for people to manage their own budget because of all the influence from outsiders, which, as we know, if you really dug into that, a lot of that is just fake, but it's in our face constantly. So it's very difficult these days to keep that budget in line. But as I will go through with the actual numbers, it is very, very important for people to be adding money to their trading account every month so that 30, 40 years later, you can easily reach your goals. And then the third thing, which of course I help people do, is you need to invest wisely. And this is where that 12% number comes in. So why do I say 12%? Why am I not one of these people that's going out saying, hey, we're going to make 40% or come to the community, I'll double your money in a year? I mean, of course, it's just not possible. That's not how investing works. And it will lead to spectacular failure if people chase performance like that. But it is not necessary. And that's what we want to talk about today. So follow-up questions to a recent article that I did talking about this 12% number. Essentially, why do I say that that is a good target? This is something that I hear all the time when I mention this is, that sounds awful low compared to what I'm hearing online. And very true. You are hearing a lot of people essentially lying about rates of return. Yes, it's very low. It sounds low. If it's not 40% a year, I don't want it, basically. But is 12% a year really enough to retire on? So one of the benchmarks that I have showed recently, that I talk about recently, is this 1% a month number. That's that red line on our performance chart. I don't post it often. People are more interested in the Vanguard VBanks, a 60/40 stock bond index fund. So that's the one that we benchmark our performance against. But it is worth noting that there is a 1% a month target number that I do believe long-term is a better number to look at. Because as we know, the S&P is on an 11-year run. It's been very good. The Vanguard VBanks is fine. But at some point, both of those are going to spectacularly crash. Right? I'm not predicting when. I'm not a doom and gloom type person. But at some point, they're going to drop substantially. And they will have a very difficult time keeping pace with even a mid to low single-digit run. I'll get into some numbers in a second, but I did a live stream recently as well, if you are interested, that was talking about this. I basically made my case, and I'm going to do one for bonds as well, but the one we did for stocks is, where are you there? This one, the one that says retirement crisis, stocks are doomed. I essentially made a case that going forward, the S&P 500 will have a very difficult time even making a 5% rate of return. So go ahead and check that video out if you are interested. But essentially, that's what we are talking about here. We are wondering, is that actually enough? Is 12% a year really enough? So what we are looking at here is a retirement calculator, just a very simple retirement calculator with only the inputs that we need. And we're assuming that somebody starts with $500, right? Say you're 30 years old, you've got $500 in your pocket, you're going to put it into a trading account, and you're going to get started on building your future. There's that 12% a year number. I know it seems low. For some people, that might seem high if you actually understand hedge fund results, financial advisors, asset managers, what the actual rate of return is. It's substantially lower than that, as you probably know. So that might sound high to you, and that's great. I hope it does. But for a lot of you listening, you're going to think, 12%, that's nothing. We're just going to go with it. 25% capital gains tax. If you do this within a tax-sheltered account, of course, you can get that to zero, at least deferred until your retirement. But I just like to use the low ball assumptions, so we're going to use a capital gains tax there. Monthly addition of $500. This might sound low or high to you, depending on your situation. Hopefully it sounds low. But yes, $500 for a lot of people is going to be difficult. And again, I'll get into a few statistics about that later on. 2% annual wage growth is about in line with history. It's actually a little bit higher. But I'm also going to inflation adjust everything. So when I say you will retire a millionaire, I mean an actual millionaire, not just a nominal millionaire. And then the inflation rate's going to be crazy and $1 million will feel like 50,000 or something. I mean, we could be facing hyperinflation or at the very least rising inflation, and wage growth has not stayed pace. So I'm just going to zero it out and have a 0% real wage growth. I think that's realistic going forward. And then here's the results of that. So it may be surprising to some of you. I don't know if you've all used retirement calculators like this, but simply put, this person, if they start at age 30, by age 70, which is an average retirement age, they have basically $1.7 million with a 12% rate of return and adding $500 a month. So this is essentially why I say in the intro there, this is why I was saying that most people can achieve this. Now, I understand it's going to come with sacrifices, and we'll get into it. 12% a year is not as easy as it sounds, maybe, but this is achievable for people. Retiring a millionaire, even if you are on that U.S. median income of $36,000 a year, if you're somewhere in that range, $500 a month would require decent savings and very, very diligent planning of your budget, but it can be done. And while it's not easy to get a 12% rate of return, it also can be done. I don't like to flash things that are unrealistic but it, our unleveraged portfolio, maybe somewhere up here, leveraged portfolio, it can be done. In my personal opinion, it must be done through risk management, must be done through drawdown reduction. It cannot be done by chasing performance and shooting for big gains. That's not the way to develop a long-term rate of return. But this can all be achieved. So let me go back to my screen share. So now that we know that it can be done, what if we just make a few different comparisons? Because maybe 12%, like I said, sounds high, sounds low, depending on who you are and where you're from, what you're doing. But let's just make some basic adjustments. So the second calculator here, 12%, let's go $500. So this is now the same, right? The comparison is exactly online. The only difference we're going to change here now is let's do something that is half that, a little bit more in line with what the asset management world, the real financial industry, is actually achieving long term. And we've got something that is significantly less. So still over $500,000 though. So obviously that $500 a month that is being added to the account is definitely still important. But the good news is, if we also do the adjustment the other way, maybe add 6%, now all of a sudden we are looking at somebody who can retire very comfortably. Actually, the number equals, at that sort of average retirement age of 70 years old, oh, sorry, wrong one, it will equal probably about $6 million or something around that level. So yeah, exactly $6 million, inflation adjusted, which obviously good news. If you are that type of person that can be a very effective investor and make 12, 13, maybe 16 or 18% a year, then all of a sudden you're going to be in a very, very good position. So this kind of leads and begs the question a little bit. Why are so few people actually achieving this? It doesn't sound that difficult, does it? A 12% rate of return sounds low for a lot of people. And $500 a month, not easy, but most people can save $500 a month if you just control your budget. So why is it that in the United States, there is only 8% of adults who are actually millionaires, net worth of over $1 million? And side note there, the average age of people in that millionaire category is 63 years old. And roughly 40% of people who are net worth millionaires in the United States don't achieve that until 68 to 70 years old, right in that retirement age, right? It takes a very, very long time. I know we're in the social media age where Everybody's making these big promises. You'll get there this year, next year. We're just going to the moon with everything, right? Everything's in a bubble, obviously, including online gurus. But it is a very long process. But why is it that if it's so easy and if the numbers are so simple here, why is it that so few people actually achieve that? Well, the first reason is, like I sort of been touching on, they don't actually make 12% a year. So that's where I was getting at with where I was pointing out the retirement crisis. People aren't making 12% a year. And this is where it gets into the realistic expectations part. Because if we just look at the hedge fund or the HFRI hedge fund index, for example, just as a broad benchmark, 10-year annualized 5.71%. This doesn't include the financial crisis. So, of course, it's going to be substantially less than that if we drag it back 15 or 20 years. But low single digits. Got an S&P 500 calculator here. The S&P is essentially one of the highest performing benchmarks that you can have out there. And we're just going to completely arbitrarily choose 20 years. We're going to adjust this for inflation. You can see 5.07% over the last 20 years. Now, this isn't a very good gauge because actually November 2001, while it's not a low, it's not an ultimate low, it's actually a fairly low period going to an ultra high period, going to an all-time high from a low. It would be more accurate to gauge it somewhere from, say, May 2000, high to high, or you could go bottom in 2001 to around the pandemic bottom. You don't want to go from a fairly low point to an ultra high point. It skews the numbers a little bit. But even the S&P 500 is looking at what it actually achieved, 3 to 5% in the last 25 years. What I suspect it's going to do going forward, because remember, we are measuring from now, from an all-time high, for the next 20 years, I suspect it'll be low single digits. So that is one of the things that makes this, I'm trying to present it as this is achievable for everybody, but the truth is, not very many people will make that 12% a year. This isn't an advertisement for what I do in any way. My live streams are free. We don't really talk about the community too much unless we have to, but there are ways to do it, but just know that actually in the reality of the financial industry, that is something that is just quite rare. And then when you factor in the fact that nobody actually puts all their money in the stock market anyway, so you've got to include a healthy portion of maybe bonds, fixed income. Those are going to be substantially lower than 5%. Obviously, with interest rates where they are, it's going to be a nightmare. You've got other things like real estate, bubble, all-time highs, starting today, going forward the next 20 years. Not anticipating a very good run there either. So unfortunately, most people are looking at a low single digit. But that 12% a year is starting to look like a better and better target for a lot of people to look into. The second thing is they don't save enough or any. And why I say or any, as we know, depending on which studies you're looking at, but in the United States, roughly half of the people are living paycheck to paycheck, right? Not saving any money. And this, incomes are low, wages are stagnating, inflation's going up, but wages are not matching. But also, you've got a situation where social media is not forcing, but certainly coercing people into just spending too much money. People are not saving as much as they used to. The savings rate as well has dropped recently. Now, obviously, very recently, because of all the stimmy checks and whatnot, we've seen some wild action there. But you can see, from 1960 to about the mid-90s, it was 10% or more. This is the personal savings rate. And then, the 90s, the early 2000s hit, and now all of a sudden in the United States, it really never gets back to 10%. It's more sort of bouncing around between about 3 and 8 or 9%. Let's say an average of 5% personal savings rate. And I would imagine, given the influences of social media and the somewhat materialistic nature of the world we live in these days, I would imagine the savings rate is going to be pretty dismal going forward. So one way that you can get ahead very quickly is you can just save more money. You can just not participate in that materialism, that consumerism. Now, obviously, you need to buy certain things. You need to enjoy your life a little bit. I'm a minimalist, but I'm what I call a stuff minimalist. I'm not a financial minimalist. I don't do things in my life to save every penny like some minimalists do. I reduce my stuff to the least possible amount. So while I can fit all my belongings in my life in 2 or 3 suitcases, when I need a new computer, I get a good one. When I go on a vacation, I go on a nice vacation. When I have a vehicle, I have a nice vehicle. But I have very, very few stuff. I'm not a consumer. I'm not materialistic. I'm not into that world. And I would suggest people try. I know it's difficult. It's in our face constantly, 24/7. But try to save more money. But this is another reason why people don't do it. So if we look back at this calculator and we make a few comparisons, first of all, we'll return to the 12 and the 500. The first thing I said, people don't make 12%. Well, what if they just make 5? What if this is just, where did my chart go? That is very odd. The chart's gone, but the comparison line is still there. What is going on? Sorry, just a quick troubleshooting here. Did I? Yeah, I deleted it for some reason. So here's the chart. 12, if we just go to 5%, all of a sudden, if you're investing with, a run-of-the-mill financial advisor, or your money's in hedge funds, or you're trying to do some 60-40 balance fund, that's going to be low single-digit return. It's going to be 5% or less, and now all of a sudden it's going to be around that 500,000 mark. Still something, but not nearly what we are trying to target today. The second point that I made is that people actually don't save very much money. So what happens instead of 150, or 500, you do 150. Right now you're only saving 150 a month, which isn't that out of line, to be honest. The median income is 36,000, and the average savings is, let's say, 5%. Saving $150 is actually in line with the average of what people do. $150 is a decent amount of savings. But again, that's going to lead to a substantially lower number down the road. That's another reason why people don't hit their goal. And the third one, of course, time is a very strong ally in compounding. And so if we go to this again, reset back to the original, 500, even if you do make 12% a year, and even if you do deposit $500 a month into your account, you're a good saver. If, for example, you started late and you only have 25 years, well, now you're at that same 500,000 mark. And this is typically where people find themselves, is some combination of the three, or a combination, or all of them at the same time. There are some people who are in that situation where all three of them are hitting them. So very small differences can lead to very big numbers. 12% a year, saving $500 a month for 40 years, which is a normal investing time horizon for most people. Typically, people start around 30, or at least I say they should, and they will retire around 70, as we say they should. That's the first group of people. The second group of people are going to make substantially less, they're going to save substantially less, and they're only going to have 25 years to do it. Now, all of a sudden, this person is at about 100, well, they're at $74,000. I think I've prepared this slide wrong. $75,000 inflation adjusted. So small changes can actually make a pretty big difference to the long-term expected outcomes here. We've got one person who's going to retire in total comfort and financial freedom with relatively not easy, but simple sounding input variables. And then we've got another person who didn't even achieve those things, which is the average person out there. We've got a very, very different situation depending on where people fall. So I suppose the overall point here, number one, I really do like to constantly dispel this myth that somehow making massive outsized profit is normal or acceptable. It is absolutely not normal. As we know, roughly 80-85% of asset managers don't even outperform their benchmark. And those benchmarks they're comparing against are typically in the mid-single digits. And like I said, going forward, it's going to be even less than that. So not achievable. And then not real as well. I mean, everything that we see online, you really have to understand that there is a reason why there's no performance ever shown. There's no real clients. Every time somebody's talking that way and they try to launch some type of service or business to try to sell those signals in those chat forums, what happens to those people? What happens to those people that are lying online, talking about how they make 100% a year? Well, the second they start collecting money from real paying subscribers or clients, you essentially start the stopwatch on the end of their career. Because obviously, if you lie, immediately people are going to realize that they're not getting the return that you were talking about. You built up your community for a year or 2 years telling all these exorbitant lies about how rich you are. And then all of a sudden, real people start following it and you're making nothing or a very low rate of return. The excuses start coming in. So what do we see with these communities that talk about those big gains? Well, it's not more than a month or two before you go on Twitter and there's all kinds of people in the comment section telling everybody that it's not real, that, oh, you said this and you said that trade and you didn't take that trade and I read your email and you didn't say that. It's a nightmare. The comment sections in these communities is just a dumpster fire. And the reason that's happening is because it's lies. Now, I don't want to always bring it back to me. I really try not to do that. But I've been doing this for 10 years. There's never anybody saying anything negative about me. I talk about realistic rates of return. I show my real performance, completely transparent, and it's not always good. And there are times when it feels like, wow, look at all these people making 50% a year, and this guy's not doing that. That's what it must feel like. But of course, I've never blocked anybody. I've never had any issues with anybody complaining because realistic long-term rates of return is what we talk about in my community. Mitigating risk, reducing drawdowns, being very consistent and stable, and understanding that this is a long, difficult process. Multiple decades, not just where are we going to be next year. This is where are we going to be in 2038? That's the type of mindset that you need to succeed in this world. And so, a lot of people ask me, well, hey, if it's so simple, how come everybody's not a millionaire? Well, everybody's not a millionaire because they get derailed at certain stages along the way. And it is my job not only to achieve the good rate of return and to deliver on my promise of that, but also to remind people and to be there to talk about investing philosophy and big picture stuff, macro stuff. Let's step back 30,000 feet and really discuss these things. I like to talk about psychology a lot, investor psychology, and I like to make sure that people understand where they're at in the process. And every time they kind of try to get derailed a little bit by all the noise out there, I would like to try to do my best to bring people back to that realistic expectations. Now, obviously, I have made far more than 12% a year since we launched my business, and I do plan to continue that. So I'm not saying that it's, that's all we're targeting. But don't scoff at 12% a year. Don't be one of those people that falls for those lies out there. Join their community if you have to. If you see somebody talking about 100% a year, they're talking about how it's just like it's an ATM machine and, just easy cheddar falling from the sky, join. Watch how quickly you don't get that in your trading account. If you have to go through the process, go through the process. But there are virtually no legitimate asset managers that I follow on Twitter that talk that way. Literally none of them. Why? Because we all manage real capital. We all have real human beings following what we do. Personally, if I'm out there talking about how I'm a volatility trader and I make 50% a year, it will take 1 month before my entire community realizes that I'm a liar. It doesn't work that way. So 12% a year, you can become a millionaire. You really can. If you've got time on your side, you've got that rate of return, and we block out the consumerism and the materialism, have a little bit of delayed gratification with the purchases that we're making, you can all do it. You really, really can. That is my job, not only to do the investing, but to encourage everybody out there that if you structure your life correctly, even if you are one of those people, and I would always encourage people to focus on hard work and determination and to try to get out of that situation, try to get as high as you can, because everything starts with income. But even if you are one of those people that are, bouncing around the median, 35, 36,000, you can still do it too. Don't think that becoming a millionaire is just for the privileged people or the lucky people, or that. Sometimes it's just people who have prudent planning and effective investing. Growing up, when I was a kid, I won't name any names, but I had a group of friends, let's say 10 close friends, and I would say most of them had parents who were above the median income. But I remember one of my friends in particular, let me try to get this straight. Father was a teacher, just an elementary, maybe junior high school teacher. Mom was a nurse, not a master's nurse, just a teacher and a nurse. And honestly, I think that as time went on and I started watching and I grew up and we went to university and I started noticing things, I honestly think, I would guess, they easily retired millionaires. I would imagine that family, I had friends, my family was fairly middle class, but I had friends who their parents made a ton of money and always seemed to have financial difficulty. But there are people out there who, on a fairly modest income, if you make good decisions, invest wisely, it is actually achievable. And I guarantee that family, not that my friends are watching this, I don't have to dance around it, but I would imagine that they are comfortably retiring millionaires. So good to see. It's nice to see that it's not just for the rich. It's not just for the doctors and lawyers. Everybody out there can all do it. So there are some pitfalls out there, so minefield, and you might want to avoid Twitter, especially. You really want to be careful who you're following on that platform, because it's an absolute nightmare. And you can see it. You can see it in the comments. You can see it in the engagements. You can see it in it falls apart very, very quickly. So you won't ever see me talk that way. I'm always about realistic expectations and long-term success. It's virtually guaranteed. If you have a very good plan, if you're a good investor, and you allow the process to play out, it's almost guaranteed. So keep that in mind. And that's why I use the 12% number. That's why even though it's significantly lower than our actual return, that's why I still come back to that, because it's very realistic and achievable. Okay, so comment section, there probably actually won't be that many because I screwed up my live stream. Again, I directed everybody to the wrong channel. That wasn't good. So I think what I will be forced to do now is I will have to edit this section, this 20-minute section on the retirement, and I will just upload it on my channel so people can actually still see it. Typically, I don't like to do that. I don't like to I see a lot of YouTubers do that, where they do an hour live stream and then they post 6 different parts from that live stream. I always assume that my community watches the streams, even though that's probably a little ambitious. But this time, in this case, since I directed everybody to seemingly this channel, how many people are on this one? Yeah. I'm so sorry. I'll figure this out. Restream. It worked perfectly the first time, and I'm sure that I did it the same process the second time. So there's very few questions, but let's get into them. Here's somebody trying to help me out. Live streaming on my Clips channel. And then you posted the live stream on your main channel in your daily emails. This is why I'm the only one here. This isn't the link posted on the email or Twitter for some reason. Same as last live stream. Yep, I did it last time as well. Many people are waiting. I messed up with my channels. Doesn't support multiple channels. Thank you. This is important for me to read this. I'm the only guy here. I'm sorry. I won't do this. I'll try to figure it out for next time. So statistically, is it better to invest $100 per month or $300 per quarter or $1,200 per year? In other words, how much does the frequency instead of total invested affect long-term outcome? Well, mathematically, the more, I'm sure you've heard the old saying that time in the market is what we're really tackling. It sort of applies here as well, where if you are putting $100 a month, and we're assuming that it's free to do that, right? There's no fee to do that every month because that might eat away at it. But if assuming that it's free and it's convenient and it can be done well, then yes, getting the money in the market as often as possible is going to allow the maximum amount of time for it to be compounded. So if you put $100 a month, you would be better off than waiting the entire year and then putting $1,200 at the end of the year. You have to remember too that investment returns compound geometrically. So 1% a month isn't actually 12% a year. It's 12.68% a year, right? It compounds a little bit geometrically, and it's a little bit better as well. So definitely if you invest $100 every single month, like for me personally, I put money into my account every week. I make my transfer every single week. There's no fees involved, so that is a very important thing you'll want to look at. If for some reason there's some $5 or $10 fee, that's going to change the whole equation. And you would, at that point, be best to do it semi-annually or maybe even, like you said, annually. If you're a business owner, I've heard sometimes people say, because of course you're going to have to pay your taxes a little bit differently, sometimes it's a little bit more convenient for people to wait and then do everything once a year. There's nothing really wrong with that, but long-term, yes. Short answer, mathematically, it will eat away a little bit. So you would want to, at the least cost possible and the most convenience possible, get that money going and building as soon as you can. Like I said, I make about 52 deposits into both of my accounts every year. I don't know if you're in that same situation. For me, it's just kind of a no-brainer because it's free. It's just transferring from one place to the other. But yep, mathematically, you want to do it as often as possible. You had the wrong link again. Yeah, I was waiting 10 minutes before I noticed. Yeah. Sorry, everyone. That's really demoralizing. You put together a live stream, you think people will be interested in the subject, and then at the end of the day, there's not that many people who are even going to see this. I'm from India. I just watched a few of your videos on backwardation. Kindly give some tips for small investors like me to tackle those period of market, switching to bond or gold. There is no short answer here, but this is essentially what I do. My entire work is based on what you're talking about. Let's go to my daily email today. My solution to the problem of trying to reduce drawdowns, because if you just leave your money, of course, as a buy and hold investor, like you said, periods of backwardation are going to substantially eat away at your long-term growth. That's one of multiple reasons why I got into before. The average rate of return of the average investor is mid to low single digits. It's not because they don't go through bull market periods. They do. Everybody does. That's a function of the markets mostly going upwards. But the problem is that markets crash, and once every 10 or so years, quite spectacularly, and I would expect one again. So yes, you will want to deal with that problem more than trying to target the bull market periods. How you do it, if you're not actually a member of my community, if you are following my portfolio, which is all VTS is, it's just my own portfolio, and I'm just sharing it with the public. But yes, we rotate fairly soon out of those seemingly risky market periods. And for example, this strategy will move into bonds quite quickly. We can roughly 60% of the time, maybe 65%, we can stay in equities, but we will rotate into bonds and gold. Our volatility strategies, this one is the aggressive vol, but even the aggressive vol is probably only allocated about 68% of the time. And we will be looking to exit out during those ambiguous higher volatility periods. This one, we're going to be going to real estate and then, of course, long volatility. These are tail risk funds, both of them. And for this one, we're going to move into utilities quite quickly and then a nice, comfortable piece of cash there. So absolutely the only way that I've been able to manage my drawdowns within my strategies is by rotating out. Because if you don't, of course, during the pandemic crash, it was down 34%. I don't want a drawdown even close to that large. So, and I don't allow drawdowns to be that close. So you are going to have to, if you're not directly following my portfolio, you can still learn from the general principles of what I'm teaching here. And you can find ways that, yes, you're going to have to cycle out somehow. The solution to just sitting there and hoping that it recovers or hope the Federal Reserve comes in and saves everything, not a very good solution. So I'm very happy to see that you are taking that rotating to safety seriously. I have my way of tackling it. It works very well for me. I use volatility metrics to gauge when is the time. It's not necessarily that when I exit to safety, it doesn't mean that a crash is going to happen. It just means that the probability of future performance is low because the volatility metrics are in between. They're ambiguous. And I would rather move to safety and be wrong 4 or 5 times in a row and then have that safety position once every few years really save me. Like for example, the Volpocalypse in 2018, didn't lose any money during that period. Q4 2018, we made a profit. The pandemic recently went flat, didn't lose any money. I would rather be wrong several times and be too conservative. I moved to safety and turns out didn't really need to. I would prefer that. And then every so often just be absolutely on the right side of the trade, not bleeding all my capital and watching the market crash. Because I am of the opinion, whether it happens in 5 months or 5 years, I don't know, but I am of the opinion that we are going to see a very, very large crash in the global economy. At some point, all of this financial engineering is going to catch up. So very glad to see that you are taking this seriously. Backwardation itself, not a great signal. That's a little inconsistent. One, because it is only one metric. It is only the VIX futures. But another thing is that if you're using that 0% backwardation line, it can be a little late. The VIX futures are in backwardation about 16% of the time. So, by default, you are essentially going to be long the market 84% of the time. In my opinion, that is too aggressive. That's too much. From about 60 to 65, I am looking for the sidelines. If you're waiting to that 84% line, you're going to take some significant drawdowns. Maybe not the max drawdown. You will probably not hit those really ugly numbers. But if you're waiting that long to actual VIX futures backwardation, at that point, sometimes a lot of the damage is already done. So just keep that in mind. It's 16% of the time. You're fairly aggressive 84% of the time, which is, to each their own. But for me, too much. That would introduce drawdowns that I'm not comfortable with. Okay, this is good. I started last year at 30. Awesome. You are ahead of the curve. And I wish I started at 25. Don't we all? We all say that. Boy, I wish I started earlier. Doesn't matter what it is. I say that about YouTube. I say that about my business. I wish I started 5 years earlier. If people start getting into shape, losing some weight, exercising, they always say the same. Why didn't I do this before? Right? I wish I all did this before. You feel so good. I can't believe I didn't always feel this way. Investing's the same. I don't think there's anybody who's ever going to be able to say they don't wish they started sooner. You wish you started at 25. If you did start at 25, you'd probably wish you started at 20. I mean, I had an extra $100 when I was 20. I didn't have much. I was struggling, but I probably could have saved an extra $100 and started when I was 20. I didn't start saving any real money until probably 10 years ago, to be honest. 35. I started late. So don't we all? Yes, the 9% return is subject to change and likely to go down, but it will most likely have a rate of return that is more than 0% for the conceivable future. Just seeing if that's a follow-up to something sooner. I think I caught you in the middle of a thought there. Oh, here it is. What are your thoughts on getting a guaranteed 9% rate of return at BlockFi on stablecoins? I'm going to have to try to politely... Okay, let's move on. Would it be a good idea to use BlockFi to get a 9% return in the VTS portfolios instead of 0% with cash? How am I going to answer this? So, I mean, obviously, I think you know what my answer is going to be. I don't like the fact that you used the word guaranteed 9%. In a world where interest rates are near zero, in a world where the smartest, most experienced, and educated people on Wall Street can't get 5%, in a world where the vast majority of investors out there will not even get 2 to 3%. How is it even possible that people think that there is such a thing as a guaranteed 9? Isn't that, I mean, that is the literal definition of free money. In this world, if you go back to in the 1970s, okay, I'm with you. 9%, yeah, you can get 9% with government bonds. So sure, it makes sense that that 9% disseminates outward, and you can get that similar range, anywhere from 7 to 12 in different areas. Never guaranteed, but reasonably confident that you could get it. What makes people think that in 2021, under the current conditions where money is so tight to even get any rate of return, that there is somehow this massively outperforming guaranteed rate of return? It's sort of like if you see a certain country with government bonds that are still paying 9%, what does that tell you about that country's credit rating? What does that tell you about the risk factor in that 9%? If the United States, under the current conditions, suddenly had some bond auction that had a coupon rate of 9%, I would hope that nobody would touch that, because it would signal immediately that there's something wrong with this equation, right? The S&P 500 dividends are, let's say, 2. There's nowhere that you can get anything even remotely close to that guaranteed return. So I have to plead ignorance on this. I don't really know I haven't dug into the whole stablecoin, BlockFi, all these things. No. Absolutely no, that is not a guaranteed, not even a remotely close to guaranteed return. It's very, very risky, ultra risky. But, I'm not saying that to say that you shouldn't do it. I'm just saying that getting 9% in whatever this is no different than getting 9% somewhere else. It's very hard, it's very unlikely, and few people will do it. So if you keep that in mind, then sure, go forward, research that industry, whatever that is, research the BlockFi. I don't know what they are. I'm way behind on I just don't really care about that kind of thing. I think it's a bubble just like everything else, a bubble like real estate, a bubble like equities. I don't really bother with it. So I do have to plead some ignorance on not knowing what you're talking about. But just the fact that if you said a guaranteed 9%, insert anything you're going to say after saying guaranteed 9, I'm going to stop you right there and say it's not even close. It's the furthest thing from a guarantee. It's actually ultra risky. And I don't have to know what the underlying thing you're talking about is to know that, because the way the world works these days, there is no free money. And if there was, certainly it wouldn't be me who figures it out. It would be some, PhD Wharton graduate with 40 years of experience who figures it out. It doesn't exist. So we live in a world where rates of return are very low. And if you ever see something or someone, it's kind of the same thing with the online guru. You've got the entire financial industry that is having a very difficult time getting 5 to 10% a year. And then you've got these people online with a Twitter account that somehow think it's easy to make 50. Who do you think's telling the truth? Do you think it's the person who their livelihood is based on it, that they have 1,000 clients that actually see the results in their account? Or do you think it's this person with an avatar online that's the liar? I mean, I'm not telling you which way to think on this, but pretty obvious to me who the liar in that equation is. I know there's a lot of negativity towards asset managers and, Wall Street doesn't know what they're talking about. They're all stupid. They're the farthest thing from stupid. And if the best and brightest on Wall Street can't make 5%, how is this BlockFi guaranteeing 9? It just doesn't make any sense. So that is a whole long-winded rant about saying, be very careful. I don't know what you're talking about, but be very, very careful. Free money does not exist in this world. I think, yep, you're the same. Okay, still going. KuCoin stablecoin lending is now offering 22% rate of return. Run the other direction. Look, if you're considering doing that, and again, I've never even heard of what a KuCoin is. If you're considering taking this, my next best recommendation would be for you to pull all money out of everywhere that it is right now and put it in the hands of a professional, because you're going to do something that costs you way more time on your time frame. Remember, time is essential in our compounding horizon. You're going to make a mistake here. I'm trying to I don't ever like to just tell people definitive yes and no and do this, don't do that. I'm trying to, in the most polite possible way, say that you are chasing something. You're chasing a ghost here. This is not going to end the way you think it's going to end. They're offering a 22% rate of return. I'm going to have to look into this. What is the scam behind KuCoin? I mean, thank you for bringing it to my attention, but that is alarmingly irresponsible. So I'm going to have to dig into that. Do we have to be members to see what you think volatility metrics spell a possible trouble ahead? I mean, technically, yes, but it's not because I'm trying to be coy or hide anything. It's just that in my daily workflow, members of the VTS community get access to the live dashboard, the most up-to-date numbers of all the dashboard. There are times when I will write an article on the website, and in a blog post, you will see numbers posted of all these things, or we talk about them all the time. It's just that won't be live, and depending on when you're looking at it, you might be looking at an outdated number. So it's not so much that, hey, you know, I need your money to do it. It's just that I don't have any other way to share it with people. A lot of my trading strategies are based on those metrics. And if I just put them out on my website on a live dashboard, then yes, it probably would defeat the purpose of structuring it the way that I have. So yeah, if you want to see my dashboard, the actual numbers, yeah, you would have to be a subscriber. Doesn't mean you can't watch the live streams for free, check out the articles and videos, and learn about those dashboard metrics yourself. You can do that for sure. Just you can't, you won't see the up-to-date. Many financial advisors recommend reducing risk dramatically at retirement. Do you plan on continuing your current portfolio methodology post-retirement? Yes, for me personally, and this isn't a recommendation that is broad spectrum for everybody, but for me personally, I don't go through those phases in my life. I don't believe in that. Well, if you're young and you only have a little bit of money, then go ahead and be more reckless. I don't believe in that. I believe in, even if you've only got $5,000 in your bank account, the goal is not to just risk it all or to get ultra risky. And then eventually when you have more money to start curtailing your risk and be more responsible. The goal is right from day one to just learn how to make your 12% a year rate of return. And once you have that skill set and that plan going forward, and you've learned to weed out all the noise and you're not chasing shiny objects on Twitter, at that point you're set for life. Then it's just a matter of structuring it so that you have a good income and a good savings rate and you're good to go. I don't believe in this, rolling scale of risk. What I do within VTS is, in my opinion, the lowest risk I can offer. This is the lowest risk I can offer. Now, this is the leveraged portfolio. So what I really should be looking at is the unleveraged portfolio. This is the least amount of risk that I think I can take. This is a baseline for everybody, no matter what your risk tolerance is. And then for people who want to take on a little bit additional risk, that's why we sometimes take double leveraged positions. We do the SSO instead of the SPY, for example. It's not leveraged risky trading. Maximum drawdown in 10 years is still 11%. It's not risky. It's just riskier. But this is what I would recommend people do. This is what I have done, regardless of how much money I have in my account. So if I started at zero, just like everybody else did. We all start at the same place. I recommend people invest correctly from day one right until they're done investing. And not to be too grim, don't want to talk about death here, but perhaps that finish line is, moving on to bigger and better places, if that's how we want to say it. But yes, I understand that many advisors say that you should take more risk early on in your career, and I don't think that makes much sense. With a little bit of attention to risk management and drawdown reduction, there's no reason why you can't be aggressive at the right times and conservative at the right times and get the best rate of return possible, even if you don't have much capital. And then later in your life, if you are risk averse, like I am, and if you are looking for the exit as soon as it's necessary, like I do, well, there's no reason to reduce risk if I'm 60 or 70 years old, or if I have some high number in my bank account. There's no reason to reduce the risk because everything I've done from day one is about reducing risk to the least common denominator already. Reduce it to what? I've already reduced it as much as I can. And now it's just about staying with the process for 30 more years, right? I've done it 10. VTS is coming up on the 10th anniversary. Now it's just, I just want to do this for another 20 years. That's really what it's about. I'm not chasing anything. I'm not investing in KuCoin and BlockFi or whatever these things are. I'm just doing what has worked for me to get my risk tolerance to the level that I can sleep at night. And we've been in a drawdown recently. I think it's fully recovered now, but it was fine. I mean, it was the fourth largest drawdown I've had in the last 10 years, but it was nothing. It was 9%. It didn't feel like much of anything. That's how I like to invest personally. I don't want to have some larger rate of return and then suffer a 30, 40% drawdown. That's just not the way I do it. So I disagree with this, but being fair to the people that do that, I understand that it's layered on many, many decades of standard practices within the financial industry. And there's nothing about my investing that is standard status quo. So just in fairness to them, they probably don't know what I do. They don't know that there are ways to cycle out like that. They've just focused on the standard methods. And yes, typically they would say your stock holdings should be large when you're younger and then diminish and move towards fixed income as you get older. To each their own. That is not my style. Okay, last one. And I didn't mean to be rude. I hope I wasn't rude. I'm just, sometimes you have to tell people the honest truth about things like this, because it does seem, like you said here, yes, I know 9% seems crazy, but just look into it. I will look into it, but I don't need to. I want to make that clear. I don't care what the thing is. Anybody who's saying that they're giving you a 9% coupon rate, a 9% dividend, a 9% government bond, don't need to look into the underlying. All I have to know is that the world as we know it today, in 2021, with interest rates where they're at, with guaranteed government 30-year bonds where they are at, it is impossible to get 7 times that money. It is impossible to even say guaranteed with a straight face when you're talking about a 9% rate of return. Not saying that whatever this is can't make 9%, maybe it can. I've made 25%, right? But for me to say I can guarantee you 9, it would be laughable. I would never say those words. It's not a guarantee. I can't guarantee you I'll make 9% within the VTS community. All I can tell you is I've made more than double that in the past, and I think that if I stay the course, I will be able to continue doing that. I would never utter the words like, hey, look at what we've done. It's just, come on, it's easy. 9%, it's an ATM machine. It's not. Every day I'm working all day long to make sure that I maintain what I do. So I will look into it, I promise you. It's intriguing to me. Again, I have to be honest, the most intriguing part is their marketing campaign. How did they manage to state it in such a way that they're a $3 billion valuation? How is that the most brilliant marketing campaign in the world? I will have to look into that, because I can tell you for an absolute certainty it is not a guarantee. The rate is variable and not stable. It is a safe investment. I'll look into it, but I think I've made my point clear. Apologies. Thank you so much for checking out the live stream here. I didn't mean to like pick on you or anything, but you have to understand that I've been speaking on camera for hundreds of hours. I've spoken to thousands of people about their investing situations. I've been doing this a very long time. And from time to time, sometimes you have to tell people a little bit more directly that take what you thought you were being careful and researching and triple your efforts on being careful. That's what I would say on that subject. All right, with that, there actually isn't that many more questions. It's been an hour and a half or an hour and 5 minutes. I'm really sorry that I screwed this up again, and there's so few people watching. That's disappointing. So I'm going to chop this up. I'm going to release it as an individual video, and I guess I'm just going to try to think up another subject and do another live stream very soon. Maybe Friday, maybe Saturday. I'm going to try to figure this out because it's beneficial for me to get the live stream on both my channels. That is something that I'm trying to achieve here. But it can't be at the expense of nobody being able to find me. So thanks everybody for who did find the right stream. And I'll do better next time. So have a great day, and I will see you very soon. Certainly within a week. Absolutely, we'll do this again. Thanks for watching.